All right, everybody, welcome to Friday night. It is 5:30. We're ready to kick off another awesome late afternoon. And boy, do I have a great guest for you today. I know a lot of you have asked me, and we're having conversations about and things that you're hearing about reverse mortgage. And you know what? I thought about the fact that I wanted you to actually listen in from an expert. So someone who has been doing it for a while, and that is the topic of our discussion today. We're really going to dive into everything that you heard on the news and the myths and the good and the bad. We're going to unpack everything. And then my suggestion to you is jot down some questions, because we're definitely going to have a good discussion after Ken and I talked about some of the major things that I think that are important for you to know about reverse mortgage and what does that mean. So let's jump in, and Ken, tell me a little bit about you, about a little bit more about you. Like, how did you end up in this industry? How long you've been doing this, and why reverse mortgage?
Nice. Well, thanks, Olga, and thanks for allowing me to talk on your show a little bit. I'm a huge proponent of the program, obviously. I've been doing it now for nearly 33, 34 years. I look forward to that day I get to retire, but I'm not quite there yet. Like a lot of us, I got into this for a job back in 1991, and I quickly realized what this does for seniors, for the senior homeowner, how it fixes a lot of things. There's so many issues that seniors run into financially. They're on a fixed income, maybe they lost a spouse and they lost some of their income, but yet they have all this money stashed in the equity in their home. Why isn't there some sort of vehicle to take that money out? And that's the reverse mortgage. And I'll tell you, in the 34 years I've been doing this, it is not for everybody. I want to make that clear to those of us that are listening to this. We want to make sure that this is the right thing for you. And when it is, and it feels so much better that that borrower now has a bucket of money that they can tap into without having to make a monthly payment on that house, it's a great thing. But they have to understand what they're getting into. They have to be educated. So in all my years, in the 3 decades I've been doing it, I've seen everything from A to Z, how it works, how sometimes it doesn't work. I was involved during the ugly days of the reverse. And I like to use the word the good, the bad, and the ugly, like the old Clint Eastwood movie, right? Because it's all not beautiful. There's a lot of meandering through the process. Incidentally, it's easier to qualify for a reverse mortgage in most cases than a forward mortgage, just because we don't have the same rules and regulations. But it's just different for everybody. And it's our job to make sure the borrower understands what they're getting into. Their trusted advisor, could be an attorney, could be a realtor, who's kind of bringing the customer to us saying, does the reverse mortgage make sense for this individual? And even the family, the children, the grandchildren, sisters, brothers. I like to get as many people involved that the borrower wants to, because a different set of eyes on it may have a different sense of what's going on. But to answer your quick question, I love what it does. I actually tried to retire about a few years ago, and I found out I missed it, and I wanted to get back in. So here I am.
That's pretty cool. So you said over 30 years, and you are strictly doing, it's been just reverse mortgages for that long?
It's all it's been.
Oh, wow. Okay. So you basically went back and you know the history of how the mortgages programs have evolved, right? For the last years. Okay.
And Olga, interesting comment is the program itself is no different than it was back in '89 when it came out, signed under Reagan. What's changed are the protections for the borrowers and the lenders and the heirs itself. We don't have enough time to get into all of that, but it's the same program as it was before. It's just much safer now. And I'm sure those of you that are listening out there have heard some of the horror stories about the reverses. It's the same program. But now we have to do a better job. We are all now licensed to do reverse mortgages in general. There's a lot more consumer protections through the CFPB, the Consumer Financial Protection Bureau, which is a result of the meltdown back in 2008, 9, and 10. And after that event happened, we saw all sorts of rules and regulations come out that we now have to abide by. We even have some protocols that if I find another reverse mortgage lender or loan officer doing something unethical or what I deem as improper, I can turn them into an ethics board. They can escalate it to HUD, the government, then they do an investigation. We never had that before uh, because the house is our biggest asset in most cases.
Hmm.
Our borrowers are a very heavily protected class. As we all know, there's scams all over the place, and we want to protect them. And the reverse mortgage, while it can be a great product, you've got to be careful. You've got to do your homework.
Actually, you know what? I just thought of another question that we can talk about because you mentioned scams, and we hear it all the time. But let's start by just talking about what is the difference between a regular mortgage and reverse mortgage. What do we need to know about the
Good
product?
question. We probably should have started there.
It's
So,
okay. We're there.
a reverse mortgage, and throughout the next hour or so, think of a reverse mortgage as a regular mortgage. It's no different. The borrower still owns the home. We, the lender, will put a mortgage on the house, except with a reverse mortgage, they don't make any payments. Unlike a regular mortgage where you make a monthly payment every single month. I shouldn't call it regular. We call it a forward mortgage. Reverses are what we do. Reverses do not entail any payment back, monthly payment, unless you want to make it. A lot of folks don't know that you can make payments on a reverse mortgage, but you don't have to. On a forward mortgage, you have to. And if you don't make a payment, they're going to foreclose on your home. So one of the questions a lot of people ask me is, how can I lose my house if I get a reverse mortgage? I'm not making payments. You still got to pay your taxes and your property charges, taxes, insurance, HOA, that kind of stuff. You got to live in the house. You have to own the home. And as long as you abide by those few little things, you can never be foreclosed on because there are no monthly payments to default. Now, if you don't pay your property charges, that's the county coming in to foreclose on you because you haven't paid your taxes. So there are some caveats that you've got to be careful with. However, with the reverse, we're going to give you so much money based on the interest rate and your age. You can do what you want with that money. If there's a mortgage or a lien filed against a property, we'd have to pay that off with the reverse, but that's going to extinguish that payment. You will no longer have to make that monthly payment. Then at some time in the future, either you're going to pass away, you're going to sell, you're going to move out, or you're going to change title. When one of those things happen, that's when the reverse mortgage will be required to be paid off. Now, here's a big myth about the reverse is we get the house when you pass away. That's absolutely false. Back in the early 60s, that was the case of the reverse mortgage. That's how they got their money back. That is not this program. This program is insured by the Federal Housing Authority or Administration or the FHA. So it's a federal program. But when you pass away, if you decide to if you live in your home the rest of your life, your estate will still get the house, just like a regular mortgage. It would then be up to them to say how they want to pay the reverse mortgage back. But as long as you or your spouse, if it's a couple, live in and own the property, you never make a payment back on that reverse mortgage money.
So what you're talking about when you said that if somebody passes away, it's the same thing. The estate would request a payoff, right?
Same thing.
Same thing. You get the payoff, and then you put the house on the market, and you work in the same transaction as we usually do when the house is being sold, right?
That is correct. Now,
okay.
Let me another little caveat I didn't mention. Because you're not making a monthly payment, your mortgage balance goes up every single month, month in and month out. So if I give you $200,000 today in cash, and you do whatever you want with it, and we're charging you 7%, let's say, at the end of that first year, you're going to owe back $214,000. At the end of the second year, $230,000. So it continues to go up year after year after year. So if you live 10, 20, 30 years, it's going to eat up a lot of the equity of that home.
Mm-hmm.
The majority of our borrowers don't care. Or they say, I need this today for myself, not for my estate, not for my children. And that's something that we try to make sure everyone understands who does a reverse mortgage. Years ago, Olga, we used to track where our leads came from, who called us. About 70% of it was from the children or another family member because they saw what mom and dad or grandma and grandpa were going through financially and they couldn't afford to live in that home anymore. They didn't want to move. They wanted what we call age in place
Mm-hmm.
because moving when you're 75, 80, 90 years old is not an easy option. So the reverse mortgage gives you that option to stay in your house and be able to afford it using the equity in the home.
And you know what, too? Majority of boomers who are now 55 and older, and as you know, there's like 10,000 of them that are retiring every day. Majority of the boomers are not interested in moving. They all want to stay in their home in their golden years.
Correct.
And I think the challenge for quite a few of them, and this is why I wanted to have this conversation, is the fact that they are not able to afford looking into some of the senior living communities. They're not able to afford it, and they would prefer to stay in their home.
Sure.
So, can you let's talk let's get the bad stuff out of the way first so then we can focus on the good stuff. But why do you think reverse mortgage has that bad reputation that a lot of people are talking about?
So there's an author out there by the name of Dan Holquist. If you guys are watching and writing it down, he's got a great book. His last name is Hulquist. He's a good buddy of mine. And he writes a new reverse mortgage book every year.
Oh, wow.
And part of the introduction in his book addresses that same issue you just said. Why has this thing got such a bad reputation? Although I will tell you, it's not as bad now as it was even 5, 6, 7 years ago. And it's a lot less worse than it was before the meltdown, because after the 2008, 9, 10 issue, all these protections were put into place. But here's Dan's thought. It's because the lenders didn't know what they were doing. Not all of them. I was pretty good at it, but most lenders didn't know what they were doing. And if the lenders didn't explain it the right way and the borrower got into a reverse mortgage and they should not have been, it got a bad reputation. It was an education thing, just like it still is today. But today we're much more, today we're getting more information out there into the public and people understand how it works and the pitfalls of it. But I think in a nutshell, or from a very high level, I should say, it was because people didn't really understand what they were doing. In a lot of cases, they should not have done a reverse mortgage. They ended up losing their home for some reason or the other.
Mm-hmm.
Also, the mortgage balance will grow, like I told you. So it's not something you can take and not expect to pay it back. It has to be paid back eventually. But again, we discuss all of this up front. It can be expensive. It's one of the biggest downsides that if somebody said, Ken, what are the downsides of a reverse mortgage? There's two of them. It's going to eat up the equity, which we've already talked about. But if you don't really care about that, meaning I'm going to live in this house till I pass away, what do you care? You're going to pass away, house gets sold, everyone, and then you're done. But it can be very expensive. So let me give you an idea. On a $500,000 home, on any home, there's 3 separate closing costs. There's mortgage insurance that's charged by the federal government, and that's equal to 2% of the value. Let's use this $500,000 example. That's $10,000 right off the bat. Okay, that's not paid out of your pocket. That's all financed into the reverse mortgage itself. The lender, the company I work for, or any other lender is going to charge an origination fee anywhere from $2,500 to $6,000. That's kind of how we get paid. Not me personally, the company in general. So you've got $10,000 in mortgage insurance. You've got $6,000 on the high end on origination, so that's $16,000. And then your typical closing costs, appraisal, title insurance, endorsements, credit report, blah, 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 blah. Call it another $3,000. So you've got nearly, or 3,000 or 4,000. You've got nearly $20,000 in closing costs. Now, if you weigh the benefits of what that is versus what the reverse does, for instance, Mrs. Jones, I'm going to give you $2,000 a month from the reverse mortgage, which is one of the options. If you tried to get a forward mortgage and you had to make payments on it, that's coming right out of your monthly income, and now you're paying interest on that money that you
Mm-hmm.
borrowed. With the reverse, that doesn't happen. You're not incurring any additional monthly expense. A better example is, let's say you have a $2,000 a month payment to a forward mortgage you're making, and you're going to use a reverse mortgage to pay it off. It frees up that $2,000. You don't have to make that payment any longer. You still got to pay your taxes and your property charges and all that, but you'll no longer have to make that monthly payment. How much interest do you think someone pays on a $200,000 forward loan? It's I don't know, 2/3 of the payment initially, or half, whatever it is. It's huge.
I think for the first 7 to 10 years is you pay very small percentage of the principal down, and the rest of it is all interest.
Correct. So when we
Mm-hmm.
look at this, and I work with a lot of financial planners and advisors, and kind of like what you were saying, oh, I don't want a reverse mortgage. It's because they don't understand the benefits. And when you
Mm-hmm.
peel back the layers of the onion, this light bulb, like right over there, this light bulb goes out over their head, and they realize, oh, I wasn't aware of that. So when you look at the benefits of the reverse versus the downsides, a lot of times it outweighs it, which we love. But again, they have to understand what they're getting into.
Can you explain to me why is there a mortgage insurance on this
Sure.
product?
Good question.
Mm-hmm.
So one of the challenges was making sure that the estate does not have to owe more on the home than the home is worth upon death or sale. What we call a non-recourse loan, which means this: neither the borrower or the estate can never owe more on the property than the property is worth at the time of death or sale. So let's pretend you get a reverse mortgage, your home appraises at $400,000, and we give you $200,000. You live a long time, interest rates bounce around because most of these are ARM products. They're variable rates. And when you pass away, your house is no longer worth 400. Let's pretend it came down. Now it's only worth 300,000. We had a depreciating time. We had another 2008, whatever it is. But your reverse mortgage continued to grow. So now your
Mm-hmm.
reverse mortgage is 450, but the house only sells for 300. So you're upside down 150,000. The mortgage insurance eats that. It does not come out of the kids' pockets. It doesn't come out of the lender's pocket or the realtor's pocket. That comes out of the mortgage insurance that was charged up front. It's a
Okay,
protection.
so that I think covers one of the myths that people are thinking about. If the house is upside down, the estate is going to owe additional money, right? Because now the balance is higher than what the house is worth. Okay, so
That
we
is
took
correct.
care of that. So the mortgage insurance is to protect you.
Correct. Or the
Okay,
estate.
for the
Now,
estate, sure.
or the estate. But let's go the opposite. Let's say the reverse mortgage is 300,000, and now your house is worth 700 grand. The kids sell it, they pay off the 300, they put the other 400,000 in their pocket. Meanwhile, the borrower was able to enjoy that additional cash coming in every month, or line of credit, or however they wanted to take the money. So that's the best of both worlds. And by the way, the average reverse mortgage only lasts 10 and a half years. That's it.
Okay, that was actually one of my questions. What are the average that you've seen? Okay, so only 10 years, right? People only use it for 10 years. Do you know why
They
is
have
that?
it. They pass away, they refinance, they sell. There's a whole bunch of different reasons. Um,
Okay.
Fannie Mae does a survey every single year, and almost every year, about 96% satisfaction rate on the reverse mortgage. The ones that are not satisfied, they were mad at the appraiser, they didn't like their lender. It wasn't the program itself, it's just some of the inner workings of the thing. But 96% of the folks say we would get a reverse mortgage again if we had to. Again, I think it's a much better educated bunch of borrowers. I think
Mhm.
lenders are doing a better job. I think we're making the reverse mortgage for the right reason and not just to make a deal. It's got to make sense.
And you know what, too, what I was thinking, if you really wanted to stretch it further, where you are, if you have a regular mortgage, you are dipping into your income, and now you're on the fixed income because you're retired. That means that the pool of money that you're pulling the money from is now shrinking, which means that you now have to adjust your calculations how long that money is going to last you, which is the big
Correct.
question for a lot of people. But
Correct.
if you have reverse mortgage, you're just strictly relying on your real estate, right? You're not dipping into your retirement savings.
Correct.
You're strictly just using your real estate as a vehicle to help you actually achieve a couple of goals, is to stay at home, make sure that your money lasts you, because if you're not dipping into it that much, then the interest is still accruing and growing. So I think that's actually a good point that some people maybe are not looking at it that way.
Absolutely. So we have this expression in the industry: house rich and cash poor. You got a lot of house, a lot of equity in your home, but you don't have a lot of money coming in. You've got a house free and clear at $300,000, $400,000, $500,000. Meanwhile, you're struggling to make ends meet.
Mm-hmm.
The reverse mortgage gives you the opportunity to take that equity back out of the house that you earned. You made payments on it for 30 years in most cases.
Yeah.
You put all this equity into the home. This gives you the chance to take it back out when you need it. Kind of like an annuity or like a 401k or something. You put all the money into it. Now it's time to take it back out without increasing your monthly expenses. Spot on. That's a good point with that. And we do see that a lot when we have a couple and one of them have passed away, a spouse. Say the husband has passed away, the surviving wife, now her income's been cut in half,
Mm-hmm.
but she still has all these expenses. They're not going away just because he passed away. They use the reverse mortgage then to either pay off all that debt. It could be a mortgage, it could be a car, it could be credit cards. Credit card usage is through the roof lately. These last couple of years, with the high inflation, the high cost of everything, people are using their credit cards more and more every month. So eventually those cap out. I mean, you got to pay them back. Using the reverse mortgage to pay those off and maybe establishing a line of credit, which you can tap into later down the road, makes a lot of sense in that instance. But yeah.
Over 50% of Americans have pretty decent and hefty credit card debt. And what a lot of people are not talking about is the interest rate on those credit cards. They're all over 20%.
Oh, yeah.
When we do perspective, that's what I always try to do is, okay, let's talk about the current interest rates on the mortgage, because a lot of people are holding on to their homes because they refinanced in the last couple of years. And they're like, Olga, but my interest rate is only 3% or it's only 4%. And now if I have to get somewhere else and I have to get maybe a small mortgage, it's going into 6, 7. And said, then, okay, well, let's talk about your credit card debt. Do you have that? Maybe. So we talked about, I think, the two major things that I know of that people have, and they automatically think about it as a bad and negative thing about reverse mortgages. One is they think that the house is going to get taken away, which we know it's not. And then depending on the value, the mortgage insurance protects you if the value of the home drops. So then you just sell and then you just pay off whatever the balance is then based on the market value, right?
Right. That is correct.
Right. Is there anything else that you can think of that you have heard? I just want to make sure we dispel the myths today about programs.
And before I forget, if there is no equity left for the children, for the estate, for whoever the house is going to, they can just give it back to us. If they're not going to make any money, why would they have to mess with all that? Then we, the lender, actually the servicer, would actually then have to take over the house. They would sell it, and that way it's going to alleviate that issue where the kids no longer have to mess with it. Obviously, if there's equity left in it, they want to sell it to put a little bit of money in their pocket. Olga, what comes to mind on the other issue is this money is finite. It will run out if you're not careful with it. And I think we got in trouble early on in its inception back in the 90s and late 90s, where people would just take a bunch of money from the reverse and spend it all. And then when they went back to the well, there was no more money left over. So part of our intake that we discuss with the borrower is, A, what do you want it for? What are you trying to accomplish? And how will the reverse mortgage accomplish that? If the borrower says, I just want as much money as possible to go to Las Vegas, that's kind of a problem. we got to kind of guide them through the process, right? So we try to structure the program that's going to fit the needs of those individual borrowers. But the money is finite. And again, you can't lose your home, but you've got to abide by those few things I said. Pay your property charges, live in the home, own the home, and maintain it. That was the other one. Sorry. You can't let your house fall down. Meaning the feds will sometimes they'll drive by the house to look at it to make sure the windows aren't boarded up or there's high grass all over the place. And if there is, they're going to make a phone call to somebody to find out what's going on. If it's determined that they have moved out or passed away, then they'll contact the estate and they'll start the process of paying off the reverse mortgage. But I think we hit upon the three biggies in terms of we don't take the house, we don't want it, right? It is your estate and the borrower is protected in case the house is upside down. It can be expensive, as we talked about, but again, you've got to weigh the options between the cost of the reverse mortgage versus what it's going to do for you. And the fact that the money is not finite. However, with one exception, you can set up a reverse mortgage and take the money out for the rest of your life on what we call a 10-year or a lifetime payment. Now, maybe you're only looking for $1,000 a month, and the reverse mortgage will give you $1,000 a month for the rest of your life. Just like your Social Security or whatever else you're getting paid, this will go until you no longer have the reverse mortgage. Whether you live 2 more years or 30 more years, you'll get that $1,000 or whatever the number is. It's not always 1,000. One of the caveats and one of the fun things I like to talk to people about is if you turn 150 and you have a reverse mortgage, you got to pay us back. So if you get that far, congratulations. And that's actually in the closing documents. So
wow. Okay, so some of the questions that usually come up when we are talking with clients, and you probably have heard it, is can I use this money to do the upgrades that I need to do to the house?
Oh, sure.
Like if I need a roof, if I need to upgrade my windows, or let's say that I need to make some modifications to the house to make sure that it's safe for me. Like if I need a ramp, or I need to remodel a bathroom and take out the tub and put in a walk-in shower for safety, can we use the money for that?
Absolutely. And that's what we call aging in place again.
Right.
Instead of you moving from your home you've been in for 20, 30, 40 years, because you can no longer really navigate it, we can bring the contractors into your home, remodel it so it's a much more safe and senior-friendly home. So I've got to say the majority of people who do reverses have some sort of repairs that are done in the house. Because honestly, you're not going to fix your house up. You're too busy paying your utility bills, your groceries, your gas, just trying to live, your utilities and your taxes. And a lot of times the homes that we see are a little bit beat up. We have an appraisal that gets done, and the appraisal will list items. It doesn't need to be pristine. It doesn't need to be up to date with all fancy cabinets and stuff. It just needs to be, we're looking for things like health issues. Maybe you got black mold growing in your house, safety issues. Maybe you have missing banisters, structural issues. Maybe you got a crack in the basement. And then some of the more minor stuff, peeling paint, what else? Broken windows. Maybe your roof is dripping. And we can actually use the proceeds from the reverse mortgage to do the repairs on the house to bring it up to average condition is what they're looking for. We do that a lot.
Okay, cool. Let me show you this. This is one of the questions that Ricky posted. He said, a lot of older homeowners don't always have the home well maintained, which is what we're talking about. The requirement to maintain the home seems to be an area of concern. Some could find themselves having to replace roofs and stuff. So I think that's what we're talking about, right? So when the government is talking about well maintained, is just to make sure that it's good living conditions, right? We're not talking about any upgrades or fancy things.
No, not at all. So, and here's a way to counter that, Ricky. Good question, by the way. Good comment. Establish a line of credit with the reverse mortgage. We haven't even really talked about the payment options.
Yes, we're going to go there next.
Oh, good.
Yeah.
Well, let me jump ahead a little bit then.
Yeah.
Because this segues great into his comment. If you establish a partial line of credit with the reverse mortgage, it works like a credit card. You got a bucket of cash. It's sitting in an account. And it does not become part of your mortgage balance until you use it. But it just sits there. And at some time in the future, if you need to fix your roof, you can tap into that line of credit and use the money from that to fix your roof. People do that all the time. That's number one. Number two, that line of credit actually grows in value on the borrower's behalf. And it's 0.5% over whatever the mortgage rate is. So if my mortgage rate is 7%, that line of credit is going to grow at 7.5%. It's one of the only lines of credit out there in the U.S. today that I'm aware of that actually has a growth feature, and that growth feature is guaranteed as long as your loan is in good standing. So, in my world, and I still originate these. I manage a channel here at my company that I work for, and I work with the loan officers. I'm teaching them how to do reverses, and I still originate myself. And I always tell the client or the borrower, you should have some sort of line of credit, even if it's only 10 grand. Put money in there because of that growth feature. But to go back to where we're going with that, there are 5 separate payment options that you can choose. And even after you choose one, when you close your loan, if something changes in the future, for $20, you can change the whole payment option. So it's kind of cool. It's really, you don't need to refinance. You just need to pay the guys $20 and they'll recalculate everything for you. But let's go through that real quick. Not real quick. Let's go through that. You can have a lump sum of cash. Say you need to pay off a mortgage. Say you want $50,000 to pay off credit card debt. Say you want to take a trip out west to see your grandkids. Whatever it is, we don't care. The only thing we care about is paying off of the mortgage. We have to do that, of course. So that's a lump sum. You can have a monthly payment for a specific time period, 1 year, 2 years, 5 years, 8 years. We see that being utilized with people. Maybe it's a husband and wife, and one of them is in an assisted facility. Maybe they have Alzheimer's or dementia, or they had a stroke. They no longer live in the home, but the one spouse does, and they have to pay this facility some sort of money every month to live there. They use the reverse mortgage on a term payment. Like I said, 1 year, 2 years, 5 years. But at the end of that term, the money stops coming in. They don't have to pay back the reverse mortgage, but the money ceases because there was only, again, the money's finite. Keep that in mind. Or you could take that same idea and spread it out over the rest of your life. Now, it's not going to be as much, because instead of a term, it's going until you reach the age of 100. That's how the calculation works. But even if you get past 100, you'll still be getting that money. You have the line of credit, which I think, again, is probably the most popular and one that should be utilized. I will do a line of credit eventually. I've got a couple more years before I'm ready to do that, because it's such a powerful tool. The growth of the line of credit is not interest, so I don't want you to think this is a taxable event. Think about it as a credit card. When you apply for a credit card and they give you a $2,000 limit, and a year later they increase that limit to $5,000, it gives you more borrowing power, right? The line of credit works the exact same way, and it's guaranteed to grow regardless of what their home value does. But again, you've got to be in good standing, pay your charges, live in the house, all that good stuff. The 5th option is a combination of those first 4. Let's say you have a mortgage you want to pay off. That's a lump sum. And maybe you want $500 extra each month. We could put it on a monthly payment, and you have a $25,000 line of credit. Easy peasy. And if something changes after you close the reverse mortgage and you want to adjust your payment options, it's going to cost you $20. See, it's simple.
Okay, so actually, you answered one of the questions was if can you have a line of credit and a monthly payment? Because this way, okay, that's good. And talk to me a little bit about the rates. Like, how does that work? And let's say, is it a fixed rate? And if it is, if the rates go down, can the reverse mortgage be refinanced? So now we have a lower rate.
Yes, and yes.
Okay.
Okay, so the rates, and I'm specifically talking about the FHA program. I'm not talking about any proprietary reverses that are out there. But again, it's a little bit different animal. So under the FHA program, what they call a HECM, a home equity conversion mortgage, those of you that maybe have done some research, I'm sure you've seen that word. Under that, there are both fixed rates and adjustable rates. I think the fixed rate currently is in the upper sevens, 7.9, 8%, someplace in there. So we haven't really done very many of those because they're very restrictive. With the fixed rate, you've got to take all the money up front, and it's not as much as what the adjustable rates will give you. Currently, so with the fixed rate, you only get the cash once and you're done. There's no line of credit, there's no monthly payment. It's a one and done, as we call it. And it's not as much as the ARM product would have. It's a little bit more complex than that, but that's in a high level. The ARM products, on the other hand, offer all four of those programs, or all four of those options. Right now, they're about 7.5%, 7.6%, someplace in there. They are high. Like all the mortgages right now, they're high. Not crazy high like they were back in the 80s. What is it, mid-teens, upper teens, whatever they were back then. They have started to come down. We've seen some drops in the rate over the last 3 or 4 weeks. And with the interest rates, the higher they are, the less a borrower gets. Reason being, the higher the rate, the faster that mortgage balance will grow. And because it's going to grow so fast, the feds will not give them as much money. Versus a lower rate, like we saw back in 2019 and 20, they were getting a lot more money then than they are today. Although we're still doing a lot of business. And to your point, Olga, when these rates drop, and we know they're going to come down, whether it's tomorrow or 2 years from now, we don't know. We will see a lot of these being refinanced and generating more income for the borrowers. That was huge back in, again, 19, 20, and 21. That was a very, very busy day for us.
So that could be actually one of the myths too, is that you're not like locked into whatever you get in the beginning. You have some options, so that's good.
Yeah, that brings up another point: is you are not locked into a reverse mortgage either. It's just like a regular mortgage. Like I said at the beginning of the show, if you decide you don't want to live in New Jersey anymore and you want to move to Florida, sell your house, move to Florida. And in fact, this is how I met Olga. Actually, you can use a reverse mortgage to buy a house. Which I don't know if we're going to touch on that or not.
Yeah, go for it. Yeah.
Say you want to, it's what we call right sizing. We don't call it downsizing necessarily. With all the boomers, as Olga mentioned earlier, coming up, turning 62, 65, 70, a lot of them are flocking to these 55 plus communities. Those are not cheap. I do live in New Jersey, and I know how expensive they can be. So they're leaving a home that's maybe a big 2-story colonial. They're going to sell it, put a few $100,000 in their pocket, and they're going to move into a 55 plus gated community where they take care of the grass, the snow, maybe there's a golf course. It's a big sprawling ranch, and a lot of times those are fairly pricey. So you can utilize the reverse mortgage to buy that house, add some of your money you got from the house you sold, and now you have a house brand new, that you have no monthly payment on. You got to pay your property charges. I got to keep saying that. But you're taking a home that you couldn't navigate through, or maybe the neighborhood changed. Maybe you just didn't want to be there anymore. And now you could buy a brand new home in a gated community where you're much more secure, protected, and you have a golf course in your backyard. So
that's an option. That's an option for sure.
In fact, it's funny you said that. I have a lot of clients who don't qualify. They have a mortgage on their home today, and because these rates are higher, they don't qualify for the reverse to pay off that mortgage. Their other option is they sell their home, they put some cash in their pocket, and they go find another house that they can utilize with the reverse mortgage. It's a pretty cool strategy. And it helps them to get out from under the burden of that monthly payment. It's retirement 101. You should never retire with a regular mortgage on your home. Not a reverse, but a forward that you're making payments on. Because God knows what could happen to you all of a sudden. Husbands and wives especially. If one of them passes away or becomes incapacitated or loses their income, you still have to make that monthly payment. With the
Mm-hmm.
reverse, that doesn't happen. We do that a lot. And
Yeah, you actually brought up a good point. People often ask, should I go ahead and pay off my mortgage before I retire if there's anything left? So, good
yeah,
point. So, let's talk about things that are important for people to know, like minimum age, some of the basics that you always go over that people need to know about the programs.
sure. So years ago, everyone had to be 62 to get a reverse mortgage. And again, we're only talking about the FHA product, not the
Mhm.
back in 2000, I don't know, 15 maybe, they changed it where you can have one spouse under 62, but the other one must be over 62. So you could have a 58-year-old, I'm going to say this, wife, and a 75-year-old husband, or 55, or 65, whatever. As long as one of them are over 62, they will still qualify. However, when we calculate what somebody's eligible for, we take the age of the youngest borrower. Obviously, if it's a single guy person, we're just going to use his age. If one of the rules of the game is the older you are, the more you're going to receive. So an 85-year-old is going to get a lot more than a 65-year-old because an 85-year-old's life expectancy is much shorter. So
Mhm.
so the Fed's going to give them more cash. Makes sense. If it's a couple, we use the age of the youngest borrower. So if one's 70 and the other one is 50, we have to use the age of the 50-year-old, which will severely restrict how much they're going to get. The general rule of thumb right now, and don't take this to heart, but the general rule of thumb right now is take your age or the age of your youngest spouse, subtract 30 from it. That's a percentage of the value of the home that you can get. So let's make this really easy. If you have a $100,000 home value and you're 70 years old, you're going to get about $40,000 or 40% of that home. And that's gross. That doesn't include taking out your closing costs. So that's one of the problems with these high interest rates.
Mm.
But again, just because you've got a spouse under 62 does not mean you cannot get a reverse mortgage. Uh, we do now have credit checks. We have to check your credit. We have to look at your income because we want to make sure that if you get a reverse mortgage, you have enough money at the end of the month to take care of all your bills. It doesn't always work this way. So we do a little bit of credit underwriting. However, what we're looking for are things like, have you paid your credit card or have you paid your debts in the last 24 months? That's really the key. You want to go back 2 years to see how things are going. And if for some reason you fell behind on your credit cards, let's pretend, um, you could probably still get a reverse mortgage, but we have to create an escrow account to pay your property charges, your taxes, and your insurance. It gets a little bit convoluted, but at one time, we didn't care about credit. We didn't care about income. We didn't care about bankruptcies, foreclosures. We didn't care any of that. In fact, we didn't even pull credit back in the early days. Well, there was a fairly high rate of foreclosures.
Mhm.
So as a result, back in 15, I think it was 2015 as well, they put these new things into place that we now pull credit, look at your income, and again, we want to make sure that if you have some dings on your credit, what caused those dings, and if there was something that um, what caused them, we may or may not have to set up an escrow to pay your property charges, which isn't a bad thing. It means we pay them from the proceeds of your reverse mortgage. You don't pay them. It gets a little bit complex, but that's how we do it. Other than that, again, we don't care about like in a forward mortgage, you have a debt to income. We want to do VOEs, employment verifications. There's a lot of stuff we don't have to do with the reverse mortgage. Makes it easier.
Okay.
Uh, that's really about it.
Okay. So I think the important thing to remember is that it's based on the youngest age of
Yeah,
the couple.
of the couple.
Yep.
Exactly right.
Gotcha.
Um, I'm sorry, go ahead.
No, I was going to ask you about the types of properties, but if there's anything else you want to add to this.
Um, you can also have a spouse, as I mentioned earlier, that does not live in the home with you any longer. Again, they're in a nursing home. Maybe they have their own home somewhere else. You can still do a reverse mortgage. You may both be signed on the property. Maybe I had a case in Colorado, husband and wife. He lived in Colorado, full-time resident there. She lived in Arizona, full-time resident there. Um, and they were both able to do reverse mortgaging on each other's home. So it's kind of cool. So I got 2 for 1, so to speak.
Okay.
The types of homes, your
Yes,
typical
that's the
single,
next question. Let's talk about that.
it's your typical single family homes that are out there. Most, I should say most, a lot of our borrowers live in condominiums. If you live in a condominium and you want to do a reverse mortgage, it has to be an FHA approved condominium. If it is not, we have a process to get your unit and only your unit approved to do the reverse mortgage. The challenge we have with that is if the HOA will work with us. Sometimes they will, and sometimes they won't. It just depends. However, if your condo is worth more than $450,000, we may be able to do a proprietary product with you, which are not insured by the federal government. It's its own little, it's a conventional reverse mortgage. Same benefits, same protections. It's not as restrictive as the FHA product. Townhomes, we do a lot of townhomes, duplexes. You can have a building up to 4 units. As long as a borrower lives in one of those units, you can do a reverse mortgage on. Farmland, but I'm not farmland, I'm sorry, farms, but they cannot be working farms. If you have like 20 acres and maybe you have some chickens that you have just for fun, we can do that as well, but it cannot be an income producing farm. And I know there's a lot of those here in Jersey as well. Um,
What
but
about a retired mobile home? Because when it's retired and actually gets parked on the land, it now becomes real estate because you now have a foundation. Is that good?
you can do them on mobile homes. Sectionals and modulars are treated like stick frames, but the trailers, like the mobile trailer, as long as it's tied down, that's been verified by a structural engineer. You have to own the land. You can't rent it. And it's got to be built after 1976. Those are just some of the high-level rules for trailers and mobile homes. But again, sectionals and modulars are treated just like single-family homes.
Okay. Ricky has another good question. He says, what about VA, veterans?
Can we do VA approved or can we approve a veteran? I don't understand the question.
Yeah, I'm not sure what you are talking about, Ricky. Is it, I guess, maybe, I don't know if he's talking about maybe as a VA loan, like, something that specifically is done for the veterans. But it's the same qualification, it would be, right? Because, right, okay.
And we, in our company, the company I work for is very, very big into the VA lending. We give a veteran a $500 veteran discount to the veterans. And I actually work very closely with our VA department. When they have a vet that they can't help for whatever reason, they come to us or vice versa. So it works out pretty good. But yeah, it'll be the same process as anybody else, but they get a little bit of a discount because they serve the country.
And then another question that Ricky posted, he actually posted a scenario when we were talking about numbers. So the $200,000 loan after 1 year with $14,000 in interest, now you owe $214 at 7%, and then a year later it's going to be $230, etc. So the amount owed keeps growing. So after years it'll be about $275. Does that kind of the growth pattern make sense?
That's the theory. It's probably going to be more than that because it compounds on top of itself.
Right.
So you're paying 7% on 229. You're paying 7% on 214. And again, it keeps growing and growing. It's not simple interest. It can get pretty big. So that's
another point. Then maybe people are not realizing it's compound interest.
Right. Yes, it's going to compound on top of itself. We've done reverse mortgages on homes that are in the $3, $4, $5, $6 million range, and with the proprietary products, the rates are pushing 9 and 10%. So you could imagine getting $1 million or $2 million at 9%. It gets pretty big. But again, it's for those individuals who don't really care what's going to happen when they pass away. That's kind of the bottom line. That's one of the questions I asked in my intake. I said, so do you really care what's going to happen to your home? If they say something like, yeah, Ken, I want $20,000 to pay to fix my roof, and then I'm going to sell my house in a year, I'd say don't do this, because you're going to spend $20,000 to get that loan, maybe, spend another 20,000 on the roof. So you just lost in closing costs. You just lost $20,000 in closing costs, and you're going to sell your house. If they have another option, utilize it. I also ask them if there's any adult child that maybe needs a home when they pass away, mental incapacitation, physical incapacitation, whatever it is, that when they pass away, they would not have the ability to pay that reverse mortgage off. And maybe they live with their parents now. Do not do the reverse mortgage. So we look at that as well.
So I think what you're talking about now is in which cases the reverse mortgage does not make sense, right?
Correct.
So if you're only thinking about having it for a few years, it does not make sense to have.
Yeah, I think the rule of thumb is 2 years or less. After that, because the closing costs get stretched out longer and you have this money coming in, it kind of balances out. But inside of that 2-year window, and people tell me all the time, Olga, I don't care, I'm going to do it anyway. All right, I told you.
Exactly.
You can lead a horse to water, but you can't make them drink, right?
Of course. Well, let's look at some specific examples. I think it'll be helpful to people. And if you want, let's run through. I have a client. I have some rough numbers with her, but this is kind of like we are in the beginning stages of figuring out what would be some good options. So she's a widow. She's 63.
Mm-hmm.
Her house is worth about $400,000.
Okay.
And she owes $100,000 on her mortgage right now. And she is in the situation where I think a lot of Americans are, where she's getting her husband's social security because it's more than what hers is.
Okay.
And that's it. That's all she's got. And she's not sure on how to best go from here. What do you think?
So using that back in the napkin math I mentioned earlier, take 30 away from 63 years old, and you get 33.
Okay.
33% of 400,000 is about 132,000. Now that's gross, right? So she's eligible for about $132,000. From there, we're going to back out some closing costs. So you have 8, 14, call it $17,000, right? Let's just pretend. Don't hold me to this, by the way.
Sure. We're doing rough numbers based on sure.
So once we back off the closing costs, now she has 115,000. We take 100 of that, pay off the mortgage, free up that debt, and she'll still have $15,000 to play with. So what it's done is it's alleviated that monthly payment, whatever it is. No more principal and interest payments. She'd have a taxes and insurance, of course. So in that instance, it would work. You know, depending on her credit, we have to pull her credit and look at the way that would go. We can kind of play with the interest rate a little bit. If it's tight, we can get some exceptions done on it. But yeah, it would work out. And that's how people use this thing. With the boomers coming of age, interesting stat, the average age has gone from 71 or 72 down to the late 60s, 68, 69 years of age or something like that. So we're definitely seeing a trend downward. And I would think if these rates were more stabilized, there'd be a whole lot more people qualifying for this thing. But yeah, Olga, in this instance, that would work for that buddy of yours, that friend or whatever it is.
Mm-hmm. Okay, so then another example would be single retiree, age 82.
Okay.
House is valued at $350.
Okay.
And there's no mortgage.
At $350?
Mm-hmm.
Yeah, I gotta calculate that one. Give me a minute.
Yep. Because now we're dealing with somebody who's older, so I can have a calculator too.
So in that instance, they're going to gross about $168,000. Yeah, let's call it 170. Let's make it easier. Let's say 170. That would give them about a lump sum of $97,000 if they wanted to take a big chunk of cash out, or roughly $1,500 a month for the rest of their life, like a Social Security payment, or a combination of those two. They could, or if you didn't want anything, you could put it all in the line of credit and use it only when you need it. And we see a lot of that happening as well. I don't need it today, Ken. I need it to buy a new refrigerator, a new roof, to go travel see my grandkids. We also see a lot of couples setting up these reverse mortgages, um, not needing it today, but having it set up today. So when one of them passes away, they have a bucket of money without going through all the rigmarole that they have to go through. Um, I
So
ran, I ran.
it's almost like having like a rainy day fund, right? If you run low one month, you dip into it. But if you're good with the income you have and you don't have to, then you don't.
Right. And that's a big strategy that financial planners and advisors use, where in a down market, you don't want to tap into your investments. Those of you guys out there that have a portfolio or stocks, whatever, you don't want to touch them. So the planners and the advisors are using the reverse mortgage in the line of credit, and they take the money out of the line of credit to shore up whatever they need for that particular month. And then the market comes back up, their income jumps a little bit. Now they leave that money alone in the line of credit, and they just keep playing that game back and forth. The number one problem that a concern that seniors have is not dying. We're all going to die. It's running out of money. The
Yes.
reverse mortgage, if set up properly, can alleviate that issue. And I love that because it was never used that way in the early days. In the early days, it was just, I need money to pay my utility bills. Not anymore. We have people that have tons of cash laying out there, but they have this house, what we call a dead asset, because it keeps you warm, keeps you dry, keeps you safe, but it doesn't do anything for you. The reverse mortgage can possibly do that by utilizing that equity.
So the one thing that I was just thinking too is, you know how if you wanted to qualify for Medicaid, there's a 5-year look back period.
Hmm.
Can you speak a little bit about that, on how that affects, let's say someone does obtain the reverse mortgage, and then something happens and they need to go into assisted living or nursing home, then what? Like, are they just, or is it going to be the same process where, okay, we have a house, we're going to sell it now because we are not staying there anymore, so it doesn't make sense to have, and then we have the proceeds to use and so forth, right? Like, is there anything that's going to, I guess, affect the process to qualifying for Medicaid?
Not in that scenario, no, because you're going to need to sell your house regardless, right? But
Right.
if you're on Medicaid or Social Security disability or any of those asset-based kind of things, and guys, I'm not an expert here. This is just what I've learned over all these years. You cannot stockpile this cash. The line of credit is exempt because it's a loan, and they can't force you to take a loan out on your house. But the line of credit is exempt from their review. But if you take $50,000 from that line of credit and put it into your bank account and let it sit there, that's a problem. So again, part of our intake, we ask the question, where's your income come from? Oh, well, I get Medicaid and blah, blah. We got to be very careful how we tread on that one. But if you're going into a nursing home or a facility and you're not coming back, that's going to follow the same course, the same series of events. But again, you've got to be careful if you're on one of these asset-based programs, how you take the cash. It doesn't exempt you from it doesn't prohibit you from getting a reverse mortgage. It's got to be set up a certain way. That's all.
Another question I have is, you mentioned that if you were to just set it up as a line of credit and the interest, the balance in it is going to grow with time.
Uh-huh.
Is there a ceiling to that? Or is it just going to keep going?
It grows and grows and grows and grows. If you could see my computer, I could run you on a chart. You can see how it just continues to grow and grow and grow. Pretty cool.
I agree. I actually like that idea more than maybe a monthly payment, because if you need it, you use it. If you don't, you have that backup. You have that peace of mind knowing that it's there to help you with whatever might arise.
Absolutely. And another benefit of the reverse of the line of credit, which we did not talk about, is if you make payments back on the mortgage itself and you have a line of credit, your mortgage comes down by that much and your line of credit goes up by that much. So if you pay $10,000 in a month, you won the lottery or your rich aunt died, whatever, and you decide to apply it towards your reverse mortgage, the mortgage balance drops and the line of credit goes up, and that whole thing continues to grow over time. Then it's pretty slick.
Oh, that's cool. Okay, so you actually answered some of the myths and some of the the things that I've heard about. So we talked about that. And let me see what else I wrote. I definitely want to get the name of that author so I can post it in the notes under the video.
Oh, yeah. I can't do that, can I?
Additional,
Want me to give it to you?
no, that's okay. I'm just gonna when you can send it to me later, and I'll add it to the notes so that way if people are interested to look him up, maybe
Okay.
Do some more reading and studying. That's for sure.
And Olga, there's a couple of really good books out there. I'll send you both of them. One's very basic, which is great. It's like an afternoon reading on a sunny day. The other one, the one I mentioned earlier, is a little bit more numbers and charts oriented.
All right.
It could put you to sleep, but you might get something out of it. I'll send you the information.
I hear you. Okay, if you have questions, now's the good time to post them, please, so that way we can ask Ken before we wrap up. But Ken, if somebody is interested in getting more information, your contact information is going to be posted under this video, so that way people can get in touch with you.
Perfect.
Is there any kind of information that you want them to have ready for the conversation? So how can they be prepared for the appointment, for that conversation? What do they need?
The most important thing I want to glean out first is why they want to do this. So give me a reason, and then I need the date of birth of all the owners of the property. Obviously, name, address, phone number, email, that kind of stuff. Home value, although I can get that myself, and then any mortgages owed. Pretty simple. And then what I do is we talk a little bit about why you're doing it and that kind of stuff. I will then send out a proposal or a scenario that has all sorts of information on it, all the federal regulations, FAQs, frequently asked questions, bunch of charts, and of course, interest rates, closing costs, all that kind of stuff. And again, it's no obligation, but as I said earlier on in the program, you've got to learn what you're doing, because if you don't know it, you're going to get in trouble. And it's important that any of you folks that have looked into a reverse mortgage in the past and you weren't comfortable with that individual you were talking to, that's not a bad thing. You got to be comfortable with who you're talking to. Make sure they're licensed in the state you live in to even be able to offer mortgages in general. So just be careful.
For sure. Are any of the costs that are associated with getting the reverse mortgage, are they tax deductible? Do you know? Or is that a question more for an accountant?
That's not my gig. You want to just put me on the spot. I do know this. The interest is not tax deductible because you haven't paid it.
Right.
Now, if you do make payments on it, you'll get a 1099 at the end of the month, end of the year. You can write it off. But again, that's not my specialty.
Okay, so there is some tax deductions there too with the interest. Okay.
Correct.
All right. Anything else that you can think of that maybe we didn't talk about, but it's still important to touch upon before we wrap up?
Yeah, so if you were using that math of subtract 30 from your age and you think you owe too much money, let's still run some scenarios for you, because if you don't qualify today, you may qualify 6 months from now as these rates continue to drop down. Do your homework. There's a lot of information on the internet, some really good, some really terrible. And again, just educate yourself, educate your family, talk to your friends. Maybe you know someone who has a reverse mortgage, or maybe you know someone who had a reverse mortgage and it has a bad experience. I'd love to talk to them and find out what happened. But, I hope to hear from some of you folks and see if this was beneficial for you. And Olga, thank you again. I really appreciate it.
All right, everybody, we're going to wrap up if there's no more questions. Ken, thank you so much as always. I know I'm going to see you in a couple of weeks for a panel discussion.
Yes, we are. Look forward to it.
Of course. All right, everybody, have a great rest of your day. And Ken, you know what? We might do it again, because when the rates come down, that might be another good conversation to have and remind people that this could be a definite option. That's what I want people to understand, I think, is the fact that if they want to stay at home and they only have their home to tap into as an asset, this could be a great option. But then you need to have a conversation with a professional like you to figure it out, whether it's a good thing or not.
I would love to be there. So thank you. Thanks, everybody.
All right. Thank you so much, everybody. Until next week.